we are going to look at 5 stocks: Southwest, Starbucks, Google, Roku, and Macys, and try to determine where we're going to buy them using our 8 pillars and stock analyzer tool. This has been so useful for our investors in our community because they're able to sit there and look at a company, look at a stock, and realize they're buying a piece of a business and buying a piece of a future cash flow. So without further ado, let's go to our stock search. First stock, Southwest, LUV. Now, guys, we're going to go right to the 8 pillars tab here, and we're going to show you. There's a lot of X's here. Because remember why? This company is coming off of the COVID stuff. It's just rebounding just now. Cash flows is starting to increase back up again. The revenue and profit are still down. Our goal, though, is to see where there's a disconnect in the market, right? So let's go look at the income statement of Southwest. It hit a peak of $20.8 billion and then came all the way down to 5.7 and is at 17 now in the last 12 months. So it's rebuilding back up. I bought Southwest for $25 back in the COVID crash. I sold it at $47 because they got called away from me. They're now back down to $41. So, in full disclosure, I have puts at much lower prices on Southwest because if the stock falls further and further and further, I want to own it. Have they taken on more debt? Absolutely. They've had to suffer their losses and take on more debt. Let's look at their long-term liabilities. They had as low as $7 billion in long-term liabilities right before COVID. It got as high as 18.22, and they're climbing back down now. They're paying it down a little bit now. So there's a lot more debt in the company, which takes away from the market cap. But just keep that in mind when you go forward. All right, let's go to Stock Analyzer tool. So I'm going to sit here and put my assumptions for Stock Analyzer tool. Let's go to revenue. I'm going to go with, since they're still lower than their all-time high, I'm going to go with 5, 7, and 9%. Profit margin, I'm going to go with 5.5, 6.5, and 7.5. Free cash flow margin, I'm going to go 7, 8, and 9. PE, they're the best airline I think of. So I'm going to call it 14, 16, and 18. And for my return, I'm going to go 12.5%. So again, the stock's at $41. And look at this. So right now, 3 of the prices are already in the green. Now you have our software and you want to look at this $35, add it to this watch list right now. Notify me when it hits below $35. So now the software and the app will notify you if you're a user who buy our software to look at the company again at $35. It doesn't mean go buy it, but understand that the fundamentals are still doing what you assumed here. If they still are, you have to decide what you're going to do from there. Stock number 2, Starbucks. Now guys, Starbucks is, we got this discussion the other day in one of our videos about moats, where I talked about Starbucks being a moat. I absolutely believe Starbucks is a moat. When it comes to, if you ask 100 people what the best coffee place is for the masses, I would guess 80 to 90% of them are going to say Starbucks. And I'm just throwing it out there. The point is a vast majority will. So Starbucks, and we've seen that people don't care about price. They're paying more they pay 10 times more for a gallon of coffee than they do for a gallon of gas, and nobody complains about a gallon of coffee. So let's pull it up here. We're going to pull up our 8 pillars. All right. So a little bit of debt, but this could be explained because of real estate leases. I don't know exactly, but that's one thing to look into. But other than that, we like everything except for the valuation. Now, does this mean you shouldn't buy it? No, of course not. Because if Starbucks has a lot of growth potential, you should still buy it. But I do know that Starbucks is starting to pare back their growth because they're pretty saturated, I guess. I mean, their areas of New York are literally across the street from each other. So let's go to our Stock Analyzer tool and input our assumptions. All right, so revenue growth. Let's see how they did in the last few years, actually, first. Oh, wow. Big time revenue growth. Big time. All right. Stock Analyzer tool. I'm going to go 2, 4, and 6%. Profit margin, 11, 12, and 13. And all I'm doing here, guys, on all these, is I look at these numbers, and the longer term ones, I tend to stay towards those. However, they grew a lot in the last 10 years, and for the growth number, I usually go a lot less than their growth number in the last 10 years. Why? Because as companies get bigger and bigger, it's harder and harder to grow at the same pace. Free cash flow margin. I'm going to call it 13, 14, and 15. PE, 14, 16, 18, because I believe in the moat, and I believe in the how it's going to be hard to jump over Starbucks to be the best coffee. And a 12.5% return. if you've watched our videos, you know that I do 12.5% return because you can invest in an ETF and get 9 or 10%. So give yourself some sort of margin of safety and some reason to buy the stock. Hit the analyze button. The stock's currently around 82 bucks. All right. So we have a low of in the 30s, a high in the 60s essentially, and the mid-range around 50 bucks. So pick your price. For me, I'm going to pick the $53, add it to my watch list, and notify me. Also, want you to know, full disclosure, I have put at lower prices on Starbucks, hoping for it to fall. So this is your first time watching us. I'm Paul. I'm a value investor. My goal is to teach value investors to average people out there who realize there's something more to a stock than just a ticker symbol. I used to be that 20 years ago. I remember thinking to myself, there's something wrong here in this crash. I don't understand how some of these stocks went to zero that were $10 billion companies before, now they're zero. That was the start of my journey. And it took many years, but I eventually realized I was a diehard value investor and it made perfect sense to me. So if you like what I'm saying, don't forget to subscribe to the channel. Next stock, the Google. So let's go to our 8-pillar search. Let's go to Google. And again, if you're a subscriber to our software, I'm sure you've been looking at these things all along with us. So Google just split 20 for 1. And we're going to the 8 pillars tab. Okay, which is what I'd like to see. Everything's checked except for the valuation, the price of free cash flow, and the PE ratio over the last 5 years for each. So again, what's Google's growth potential? I don't know, but look at this debt level. They can pay off their debt level with their entire long-term liabilities 1 year of their average free cash for the last 5 years. So let's go to the stock analyzer tool and figure this out. So guys, with growth, Google's grown a lot in the last 10 years, 21% a year. My goal is to make very conservative assumptions. This might seem too conservative, but you got to remember the pendulum swings. And I look at Google and say, is it possible that we grow 20% a year again for the next 10 years? Sure. But come on, it's probably not going to happen. So I try to go and pick a very low number, a very high number, and somewhere in the middle. So very low, 6. Middle, 9. High number, 12. Profit margin. I'm going to go 21, 22.5, and 24. Free cash flow margin, same thing. PE, I'm going to go 14, 16, and 18, and same with the price of free cash flow, because I do believe Google has quite the, nobody says, hey, Yahoo that. Google is the search engine. They're the online advertising engine. This is the place for them. So finally, 12.5% return. So the stock is currently at 112. Again, after the 20 for 1 stock split. Okay. So if you believe all my high numbers, 130, but also assumed 18P and 18 free cash flow, multiple. Remember, guys, as a company gets bigger and bigger, it's harder to justify a higher PE because higher PEs are really reserved for higher growth companies. There's a thing called the PEG ratio, the price to earnings growth ratio. Now, this is revenue, but the same idea applies. If they can't drive the revenue fast, it's going to be harder to drive earnings fast. All right? But somewhere in the middle, 90 or so, and the low end is 60. So again, I'm going to add it to my watch list as part of our software at $91. Notify me when it hits there. All right? Next company, Roku. Now, guys, this is one of the Cathie Wood lovers of love. So just it being Cathie Wood stock makes me want to avoid it because Cathie Wood is a terrible, terrible, terrible investor. She's a terrible manager of money. She's not an investor. She is a destroyer of wealth. So let's look at Roku. Now, here's the interesting thing about Roku. It hit a high in the last year of 486 and a low of 73. It's currently at 87 bucks. And that's at the high. Yeah, 486 is basically the high. So you'd think it's down 80%, 83%. This would be a good buy. Just because something is discounted does not mean it's a good purchase. If that's the case, and my house is worth $300,000, I'll charge you $1 million for it. Oh, you don't want it? How about $600,000? It's 40% off. You're still not going to buy it because it's still worth $300,000. The comps are all $300,000. So let's go to our stock analyzer tool. I'm actually interested to see how Roku has done in revenue. Whoa, wow. I'm actually surprised by that. Big time revenue growth. They're making money. That's good, but they have losses. If you guys look right here, one of the things I want to consider is there were losses in these past years. That's going to affect their profit margin going back. So you have to make sure you focus on more recent years. All right, so 8 pillars. Oof. So guys, look at this one. 58% increase in shares outstanding. This is not some sort of stock split. This means that the company had 10 shares, they now have 15.8 shares. But if you owned one of those 10 shares before, you own 10% of the business. Now you own 1 out of 15.8 shares, which is roughly 6% of the business. They have basically screwed you as an investor. So even if the revenue and profit's up 58%, you've essentially gone nowhere because now it's being split up by 58% more owners. Do you like that? This is the silent killer of investing. This is one of the main things that Cathie Wood does not understand. So let's go to the stock analyzer tool. Now keep in mind the stock analyzer tool does not factor in share change. You have to remember that as you're doing this. So revenue growth. Let's go with 6, 9, and 12. Profit margin. I'm going to go with 5, 8, and 11. Free cash flow margin, 5, 8, and 11. PE, 14, 17, 20. 14, 17, 20. And guys, I'm going to do a 15% return because it's a little bit riskier without as much data. I only have 2 years of profitability. I want a higher return for this. Hit the analyze button, $88 a share. Sorry, Cathie, I disagree with you. She thinks that her fund has 45% returns potentially. If you want 45% returns on Roku, based on my assumptions above, you need to pay $3, $6, or $11 per share. It's at 88 right now. And based on my 15% returns, the price to pay is a low of 13, a middle of 30, and a high of 57. So it's still got a ways to go in my opinion. Now you might sit there and say, Paul, you're being too conservative. Yes, you're right. My goal is to be conservative, but you'd be surprised how many times, especially, remember one thing, during bear markets and recessions, profit margins contract. During bear markets, growth doesn't happen as much and as easily. So just remember that. We're at the peak of a cycle here. You've got to factor that in when doing your assumptions about the future. And the future is hard to figure out. It's too hard. You can't even tell me what's going to happen next week. You're going to tell me what's going to happen to these companies in the next 10 years. All the rosy outlooks would happen. Give me a break. Last company, Macys. Oh my Lord, Macys. Talk about a dead company, am I right? Macys. Let's go to M. Their stock has been, I think, oh wow, it hit a high of 37. It's fallen in half since. 5 years ago, 4 years ago, it was $40. During the crash, it was $5. Oh my Lordy. Let's go to the 8 pillars. Oh. So look at this. PE is really low, really high. The price of free cash flow is very low. So guys, this is retail. This is one of those ones that put a very, very, very big desired return in. Macys is struggling. I still shop at Macys. I like going through there, but when I go through there, I realize how empty it is. But they have some strategies to grow their revenue and grow their profit. So let's go see what their income statement looks like. I mean, the revenue is up, but it's still not what it was in the peak. The peak of 2015 hit $28 billion in revenue. So guys, if I had told you in 2018, 2015, that they would do less revenue 9 years later, what would you have said to me? Oh, come on, it's Macys. They're awesome. This is why I say be conservative. Because things change, especially with technology. I look at Roku and I look at Google and things can change. Things can change very quickly. So let's go to the stock analyzer tool. Now, guys, I'm actually going to go crazy. I'm going to go negative 3%, 0, and 3% revenue growth. For profit margin, guys, look at the last 10 years, they've only done 2.7%. So I'm going to go 2, 2.75, and 3.5. Free cash flow margin. I'm going to do 3.5, 4, and 4.5. PE. I'm going to go with 7, 9, 11. 7, 9, 11. And my desired return, I was pretty conservative, so I'm going to go with 15% desired return. $18 stock. Okay. This might be a buy soon. Look at it. We got low prices here. We got 10 to 15 here, 17 to 25 here, and a high of 30 to 38. So if they go below $10, it's probably some sort of buy, even with 3% revenue fall every single month, every single year, I mean. That's a pretty big deal. So don't forget, a dying company still has value. There's still a stream of cash flow when a company is dying. If you like what I did here, check out this video above on PayPal where we analyzed it and gave you a price on it using our 8 pillars and our stock analyzer tool. Thanks very much. Don't forget to subscribe to this channel.